Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets. He's a great educator, and he's there to help facilitate your conversation and answer your questions. So thank you for joining me here in the chat, whether you're here with us live or whether you are in the recorded version. We appreciate you being here. Be a part of the conversation, comment and leave questions, and we'll try to answer those as best we can along the way. We love to hear your feedback. We love to hear your comments and see your questions. We try to answer those as best we can, as that is the point of this discussion, is to help you to understand better these topics that we're talking about. So speaking of that, we're going to talk about index options today. We're going to answer a couple of questions that have come up in the feedback surveys, one namely regarding the difference between AM and PM settled index options. We touched a little bit on it last week. I wanted to touch on it again today. In fact, I'm even going to do a short video on it that we're going to post here on our webcast page in just a little while. But we'll talk a little bit about that. We'll manage our 14-day, 7-day SPX strategy. And we'll talk a little bit about turning a long option into a diagonal spread using index options. Not that that's unique necessarily to index options, but the position might give us some potential for utilizing one of the benefits of index options, and that is the fact that they don't allow early assignment. We don't have that early assignment risk. So we'll talk about that as we get into this discussion. A couple of quick housekeeping items as we jump in this morning. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy. Remember that investing involves risk, including loss of principal, past performance, no guarantee future results. Remember that equity and index options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy, index or otherwise. Also, remember that when we're talking about equity options, we're generally talking about American-style options, which can be exercised at any time up until expiration, which means that if you're short an American-style option, you could run the risk of early assignment prior to expiration at any time, regardless of whether that option is in the money, at the money, out of the money. It doesn't matter. European-style index options, on the other hand, don't allow exercise until expiration, and therefore that removes that potential for early assignment if you are short the option. So that is one of the benefits of trading an index option. We'll talk more about that as we get into this discussion. Now, a lot of different ways that we can look at the market. Probability analysis, technical analysis, both we're going to talk about today. Those are all theoretical in nature. None of those are guarantees as to what the market is going to do. But as a result, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to be using the thinkorswim desktop software platform today, specifically the paperMoney version. One of the things to think about is the paperMoney version of the platform does some things a little bit differently than the live version does. One of those is doesn't allow for early assignment of short options. But since we're talking about European style options, we don't have to worry about that. But number two, it doesn't allow for things like studies to be used in scans, things like that. There are some differences. And it's important to remember that when you're trading using the paperMoney platform, generally order fills are going to happen right around the midpoint or the mid price between the bid and the ask, where that might not be the reality when you get to trading a live account. So be aware of that as you move your practice from paper trading to live trading, that there are some differences. So just keep that in mind as we get into this discussion. And as we jump into any of these strategies, just remember again that as we talk about these index options, these are for illustrative and educational purposes only. We're going to talk through some of the characteristics of these strategies. So let's do this. Let's pop over to the thinkorswim desktop software platform. Let's take a look at what's going on in the indexes right now, because we've had a little bit of a move in the last couple of days. And yesterday's move was pretty significant. And I think it was kind of an interesting perspective when we saw the SPX make a big move to the downside and then kind of created this bit of a hammer-like candle and a move to the upside. And we see that across not only the SPX, but we see it on the NASDAQ as well. We see it a little bit on the Russell. But I think the clearest example of kind of a hammer candle occurs here on the SPX. So we'll talk about that first, kind of in that perspective. So we got that gap down and that little bit of a rally, suggesting, not guaranteeing, but and this is kind of the theory. And remember that things like support and resistance are theories; they're not absolutes. If they were absolutes, then we could plan absolutely on prices moving in a particular direction at levels of support and resistance. But because they're theories, because we know that circumstances can change, price doesn't always move in response to levels of support and resistance. But in this particular case, we got to bounce up off of that, just about the 50-period moving average, a little bit higher where that bounce came. We got kind of a true hammer candle here, which was a gap down into a push to the downside, and then it rallies back up. And I'm not really hung up on, as many of you know, I'm not too particular, not too precise about the definition or the size or the shape of that particular candle, but this is a pretty good example of a hammer candle. And then we see this gap up today and a little bit of a rally right back up into this range. So we're still kind of range bound. We see the RSI shifting back here a little bit more bullishly. One of the things, however, though, that we saw this move drive in the indexes kind of as a whole, and trend is still intact. The trend lines are still intact. The RSI, that momentum indicator, still intact here. We see that across, again, the indexes. The NASDAQ still giving us a little bit more of a gap up and rally up today so far, about 1%. We see the Russell 2000 doing the same thing. Still some very strong trend lines going on, and the RSI moving hard. But the one thing that I think that we saw a little bit of a change in was the VIX and the nature of the VIX. And given the fact that now we're kind of out of that summertime time period, we've been talking about the VIX for a while as an index, and we've in fact traded the VIX a number of times. So what I wanted to come in here and I wanted to look at really quickly was the move that the VIX has made in the last couple of days. So we've seen the VIX kind of move back up above this 30-period moving average. This is just a 30-period simple moving average of the VIX index, which is in and of itself a 30-period average of in the money, at the money, and out of the money options on the SPX. And so this is reflective of options pricing and how the options market is pricing those products. And so now we see the VIX a little bit higher than its average. Its typical range has been in the last few months down in this anywhere from about 14 to about 18 on the high side. We saw a little bit of a spike back here. We've seen a couple of little minor spikes recently, and yesterday was one of those little minor spikes. We topped out right around the 19.43 range, kind of in the middle of the 19 handle in this particular case. Now we're seeing that VIX bleeding back off a little bit. But what that little blip did is it kind of broke this VIX out of the range-bound area that it has been in. And so if we look at some of the other indexes, obviously if we were to look at the volatility of the VIX, and I'm just going to pop this up here, we see that the volatility of the VIX, the VVIX, has spiked a little bit higher. That means protective products have become generally a little bit more expensive. So this, from the standpoint of buying protective products, meaning buying VIX options or buying SPX options or buying Russell 2000 options, RUT options, or NDX options to provide protection. So for instance, in terms of hedging a portfolio, if I were an institutional investor, I might buy SPX puts to hedge against downside movement in my portfolio. But what I also see is that those are now relatively expensive relative to where they have been. That volatility of the VIX has indicated that it's gone up. Those option contracts have become more expensive. So it's a little bit less efficient to buy protection now. Well, that gives us an opportunity, though, to take advantage of that characteristic of index options as a tool to hedge a portfolio. To answer Mo's question, are indexes good to hedge your portfolio? Well, indexes are simply a tool to be able to do that. And they're a tool that gives us a lot of flexibility in how we use that tool. It's a tool that is used by many institutions. In fact, that was one of the reasons why options became a thing, was to provide protection for long stock portfolios. So thinking about this, then we can, being flexible, utilize the fact that VIX options, or that SPX options generally across the board, index options generally across the board, are a little bit more expensive. We can use one of the characteristics, which is that European style nature of these index options, to create hedging positions by selling options and avoiding that early assignment paradigm. So, possibility. So let's kind of think about this as we get into this discussion. So keeping this as our backdrop, I wanted to do a couple of different things. The first thing I want to do is I want to go back over here to our chart. I want to switch our chart back to our single grid. And for those of you who are brand new, this is just the kind of playground that I use in terms of the just looking at individual symbols. So we're looking at the SPX here in this particular case. So this is a broad view. We're going to refine our focus in just a little bit, but I've got that implied volatility. And this implied volatility is going to be roughly that volatility of the SPX, which translates into the VIX to a certain extent. They are not exactly the same, because remember, the VIX is a 30-day average of in the money, at the money, and out of the money. This is the actual absolute implied volatility of those options, and it has a little bit longer look back period. So this is going to be a little bit more smooth, but you can still see that little blip higher here. Now, this kind of skews this spike on the April tariff pullback on the market, kind of spikes and skews this volatility. But if we zoom in into the near-term time frame, the last 2 or 3 months, we can kind of see a more refined view of what volatility is doing. So volatility is relatively high and falling. That benefits selling strategies, right? Volatility high and falling benefits options selling strategies, because that falling implied volatility, that Vegas sensitivity, is going to work in our favor as the seller of an option. And if we can do that without the risk of being assigned early, then that helps us from the standpoint of, one of the reasons why we use an index option is to avoid that possibility of being assigned early, so that we can plan on closing the trade down positively prior to expiration, to avoid that possibility of being assigned even if the stock or the index makes a move. So given that, we've put together this strategy. For those of you who are brand new to this discussion, and again, welcome to all of you if you are brand new, I'm going to do one thing really quickly, do a little bit of fan service here, and just ask you to click on that subscribe button down at the bottom of the page. I'll show you a little bit more about why that is important in just a minute. But right down here, there's that subscribe button. You'll see it down there on your YouTube screen. Click on that subscribe button if you've not done so already. It's no cost to you to give us a follow. It helps you out. It helps us out. Brings this content to a lot more people. But one of the benefits of trading index options is kind of that binary nature. It is at expiration, because these are cash settled indexes. If you were long the option, you would simply end up, and it were in the money, you would end up with cash in your account. If you were short the option, you would end up with, and it were in the money, you would end up with a debit out of your account. It's either intrinsic or nothing when it comes to an index option at expiration. It either has intrinsic value or has nothing. And that intrinsic value becomes cash settled. You don't end up with a long stock position that you have to hold over the weekend. You don't end up with a short stock position you have to hold over the weekend. You end up with cash or a debit. And in that particular case, that is a scenario that is attractive to some investors. So let's look at this particular strategy that we put on. I'm going to go to our monitor tab and let me kind of line out this strategy. The latest iteration is this. So a week ago when we were in this particular class, and for those of you who were with us at that point, we sold a 10 September expiration. That is 7 days from now. We sold a 62.90, 62.70, 20 wide short put spread. We brought in $1.60. It is now trading at $1.55. Yesterday, when I looked at this, this was trading at about $3. So if we had closed it down at that point, we would have ended up taking some loss in the trade. But now we're at a point where we're just about at the break-even point. Now, a lot of people have asked the question, why do we close this down prior? Why don't we just let this go until expiration? And I'll show you why. I'm just going to draw this on the grid here so that you can see it. Some of you are familiar with this view right here, which is the time decay curve of an option. So an at the money, an ATM option decays away like this, right? And as we get closer to expiration, it decays away faster as we get closer to expiration. So this is price of the option, and this is time. That's my little clock right there. That's time to go until expiration, okay? So that's the at the money strike. Well, we're not talking about when we sell this vertical spread, we're not talking about the at the money strike. We're talking about an out of the money, a far out of the money. In fact, about a 15-cent delta or so. We're talking about a far out of the money option. And so the curve, that time decay curve for a far out of the money option, in fact, looks a little bit different. It goes a little bit like this. Let me ask you this. How many of you have traded vertical spreads before and you've found, short verticals oftentimes, and you've found that as you get closer to expiration, it feels like it takes forever for that last little bit of extrinsic value to decay away and that option price to get down to zero. Anybody ever felt that when you've sold a short vertical spread? If you've been selling a short vertical spread out of the money, this is likely what's happening. The majority of the time decay function occurs kind of in that first third of the time frame. So if this is 1/3, and then this is 2/3, and this is 3/3 until expiration. Okay. So as we look at this, the majority of the time decay occurs in that first third of that time frame. And you're right, Ricebird, absolutely. If you were doing a short iron condor, for instance, if you had a short vertical spread above and a short vertical spread below, same thing. You get down to the last couple of weeks to go until expiration, or the last week to go until expiration, and it feels like it is just dragging in terms of that time decay. And this is the reason why. Especially if those are far out of the money, especially if the underlying is kind of right in the middle of the iron condor, this is the thing that's getting you. So the reason that we're doing this 14.7 is we're kind of getting to this point, right? So we're looking at selling this at 14 days and buying it back at 7, which we'll kind of put right in the middle there. So we're capturing the kind of big meat of this time decay curve. Beyond that, kind of in this range right here, we're just not getting a lot of bang for the buck in terms of letting it go until expiration. There's just not a lot of benefit, especially if it's out of the money. And we're carrying, by the way, all of the risk of the trade in the index making a big move. So that's the reason why we're selling it at 14 days and we're buying it back at 7. Now, could we expand this? Yes. Could you go sell it at 30 and buy it back at 20? Or buy it back at 10? Yeah, you can do whatever you want, right? I'm just doing this in terms of convenience for the sake of, there's nothing magical about 14 and 7. I'm doing this as a matter of convenience for the sake of this class, because we teach this class every Wednesday, and we're using index options that have daily expirations so that I can do that. I have that flexibility to do that. So Bob at Epic Small Steps asks this question: how has this strategy in paperMoney performed over time? And generally, it has performed fairly well. Generally, we've been collecting about 50 to 80% of our maximum theoretical gain in the trade. A couple of times we have taken our max theoretical loss. A couple of times we've taken some loss in the trade. And like today, right now, we may end up taking no loss, but no gain, and just kind of breaking even, and it's just a push. Because we can see that right now it's trading at 160. We sold it for 160. It's kind of bouncing back and forth to 160, 165. Now, we don't put a stop on this. I don't put a management order on this simply because I want to demonstrate. But you could put a management order on this that says, fine, close it down if it gets to 80% of the maximum theoretical gain. It's already risk defined. So we're going to position size to risk to that maximum theoretical loss. But there's a lot of different ways, a lot of flexibility. So the reason for this strategy is to kind of give us that repeatability and that consistency. So Harry asked a great question: how did I decide on one standard deviation from the at the money strike? Okay. Now, you could, Ricebird, yes, you could allow it to expire out of the money if you wanted to, but you're not getting the benefit of the time decay, because that curve flattens out. It flattens out extremely as we get closer to expiration. So you're not getting the benefit of time decay going into expiration. So you may be holding on to all of the risk for the sake of a very small amount of additional premium. That's the reason why we look at taking this off. So the reason, let's go back to deciding on one standard deviation. If we think about what one standard deviation is, one standard deviation is the range. While I've got my drawing tool here, we might as well draw this. I don't want to trigger anybody in terms of their high school or college statistics classes. But one standard deviation, if we were to define that one standard deviation range, is the range in which the vast majority, right? The vast majority of the price returns are going to fall. They're going to fall within that one standard deviation range, right? A lot of them are going to be clustered right around the midpoint. That's why it's going to be the midpoint. But you're going to have some over here. You're going to have some over here within that one standard deviation range. And then occasionally you're going to get some price returns out here on the tails. And as volatility increases, this curve widens out, right? As volatility increases, the curve flattens and widens. You get deeper tails. As volatility decreases, you get a steeper curve and narrower tails. We'll get into that discussion as a long time, but that is kind of the idea. Is the reason for choosing this range is because that's where the majority of the trade is going to fall. And so if we sell outside that range, right? If we sell somewhere down here, and our goal is to have this option get as cheap as possible, as quickly as possible, or have this spread get as cheaply as possible, as quickly as possible, then selling outside the one standard deviation range gives us a higher probability that this is going to be out of the money at expiration or when we take the trade off. So using that one standard deviation range is playing the probabilities of this trade. Well, now how do we determine that one standard deviation? So I'm going to go to the chart again, and I'm going to change this to our index grid. And let's come over here. I've got my index options grid and we've got the SPX. And I'm just using a tool called the probability of expiring cone. That probability of expiring cone shows a 1 standard deviation range from the current price of the index. And that's based on implied volatility as part of that calculation of that 1 standard deviation. And so then I'm going to set a time frame component to this. So the last one that we did was right here. We sold it down here at around that 62.90 as part of our vertical spread. So I'm going to delete that time hack at this point. And I'm going to look at my trade tab and I'm going to say, here's the SPX. Where's my option that expires? So here's the one that's 7 days to go. That's the one that we've got on currently. Where's my 14 days to go? That's the 17th of September. So we're going to go to the chart and we're going to put that time hack on here. I'm going to use this tool right here, which is the time level. And I'm going to go to the 14th, right? The 14th of September, which is right here. No, what did I say? Trade tab. No, 17th of September. Sorry, 17th of September. 17th of September, and I'm going to put time hack there. Okay, and then I'm going to come in, and you notice, because implied volatility is expanded, this is now being sold. If we were going to sell this, we're going to likely sell this outside of where we sold it before. So I'm going to put a crossbar right there at the 62.40. So we're going to likely sell at the 62.40. That's the intersection of our time and our 1 standard deviation. So Prakash says, why 14 days? Well, 14 days is a repeatable time frame, number one. Number two, 14 days gives us kind of a balance in between the amount of premium that we're bringing in and the length of time that we're in the trade. Like I said, you can go further out in time, and you can do 30 and 7 or 30 and 10 or 30 and 20, whatever you want to do. I'm doing 14.7 because it's repeatable within this particular discussion and within this particular webcast. So the first thing I want to do, though, is I want to go back to our monitor tab and I want to close this one down before it gets any more expensive. So I'm going to right click and I'm going to create a closing order. Now we're going to close this down come what may. But in this particular case, I'm going to put in a limit order and I'm going to say, look, if we can get out of this for $1.80, now we're going to take a little bit of a loss. We're going to take a 20-cent loss in this particular case because that implied volatility has decreased a little bit, but it's also, yesterday we saw a big spike in implied volatility. So that's holding this price up a little bit. As we get closer to the end of the day, this is very likely to come down a little bit in price. So I'm willing to close this out for $1.80. Let's see what we can get for it. Click on confirm and send, read through the order, make sure that this is an order to close. And I'm going to put this in here. We're going to go ahead and click on send. And we close this down for $1.80, which is fine. We lost 20 cents on this trade. I was talking through this, which is why we didn't get it at $1.60 in this particular case. Now remember, this is paper money. Your mileage may vary when closing this down on a regular live trading account. So let's go back to our chart really quick. We know that our level here is 62.40. And we're going to go back to our trade tab. We're going to go to that expiration, the 17th September. I've got 100 strikes in here because I need to have, again, let me change this layout to Delta Theta Vega. We were at the 62.40, right? That's about the 17-cent delta. And so we're going to, and you can see that that's about a 20-cent wide bid ask spread. So we're going to sell the 62.40. And we're going to buy the 62.20. We're going to keep this 20 wide. Now, could you make it wider? Yes. Making it wider means you're going to get more premium, but you're going to increase your max theoretical risk. Keeping it at 20 is kind of balancing between that. Could I go 10? Yes, I could go 10. I could go 15. I could go 40. Again, adjust the width of the spread to manage your maximum theoretical loss in the trade. That's the adjustment that you have in your control in putting the trade on. So I'm going to go ahead and I'm going to click on the 62.20. We're going to buy the 62.20. we're getting $2.10. We haven't gotten $2.10 for a while, again, because implied volatility has been low. The VIX has been grinding lower. So we're going to click on confirm and send, and we're going to read through this order. We're going to put this in our we're going to put it in our index options weekly group. And we're going to read through the order, make sure that we're aware of this. 62.40, 62.20, short put vertical spread, bringing in 205 to open the transaction, which means that our max theoretical gain in the trade is 205. We're probably not going to get that. We're going to maybe get 80 to 90% of that theoretically, hopefully. Our max loss, on the other hand, is 17.95. Now, where would we get max loss on this particular trade? We're not going to get assigned early on the trade because it's European style. Where we would get max theoretical loss on this trade is if the index made a big move to the downside, in fact, beyond a 1 standard deviation move, beyond that 17% probability of this option being in the money at expiration move, and that's the point at which that would really work against us. We could theoretically take that max loss. The other way that we could theoretically take this max loss is if we were to let this trade go and go in the money all the way to expiration, and then it's going to settle for intrinsic or zero, depending on what it is. But we're not going to let it go all the way till expiration. So we're going to click on send. We're going to fire this order off, and we got it for 210. And so now we're going to come back. We're going to look at this on the monitor tab. Here's our trade. We sold it for 210. We want this to get as cheap as possible, as quickly as possible. We want this to get as cheap as possible, as quick as possible. But if we go back to the trade tab, I want to just look at this really quickly. And again, I know we're spending a fair amount of time on this. There are a couple of things else I want to do in this context, but some good questions that you've brought up about this discussion. Okay, so if we look at the net delta or the net Greeks of this, I've got delta, theta, and vega on in this particular case. So if we look at the net delta is about 2 cents. This is not directionally sensitive, right? 17 cents minus 15 cents, that's 2 cents of net delta, not directionally sensitive. Time decay, $1.85 minus $1.76. $1.85 working for us minus $1.76 working against us. It's about 9 cents per day of time decay. Not huge, but important to pay attention to. And volatility sensitivity. So we've got 319 that's working for us if implied volatility goes down, against us if implied volatility goes up, minus 297 in volatility sensitivity, or vega, the option Greek vega. So we're left with net 22 cents of positive vega, which means that if implied volatility goes up, that's working against us. If implied volatility goes down, that's working for us. And Carol says, VIX just breached 17. The VIX is moving higher a little bit, right? So if the VIX is moving higher, well, that's working against us. Let's go to our monitor tab. What are we seeing happening to the price here? We're seeing that price kind of bouncing up a little bit. It's bouncing up and down, largely probably due not necessarily to the index moving, because this is very delta insensitive, but this is sensitive to implied volatility primarily. So if implied volatility goes down, that's working for us. If implied volatility pops up a little bit, like Carol says, that's going to hurt us a little bit. Now, what was this trade again? This was a short put vertical on the SPX at 14 days to go until expiration. We're going to look at taking the trade off at 7 days to go until expiration. Not a recommendation, simply an illustrative and educational example. So we sold the 62.40 and we bought the 62.20. This is European style, to answer Jacob's question, meaning European style in that these options cannot be exercised prior to expiration. The only time a long option holder can exercise that option, an index option that is European style, is to wait until expiration, and at expiration, then they can choose to exercise that option. They cannot be exercised prior, like an American style equity option, like an option on Google or something, right? As an example, not a recommendation, simply an illustrative example. So that's the difference. And that's one of the benefits, because it allows us to use short options without that fear of, without that risk of early assignment, which gets me to the next discussion here really quick. And I know so let's go back here to the chart and let's take a look at this one. RUT, Russell 2000. This is the Russell 2000. Once again, there's our one standard deviation cone. The reason I put this, the way that I put this on the chart is I just simply, if we move to this chart, let's go to maximize the sell. It's a study. And I just put that study on the chart. I can just type in probability of expiring cone, and I can put that on the chart. And now I've got it right there. All right. So I've got that on the chart. Now, how did I get the option expiration vertical lines? You can put that on there by going to the gear icon, and you can show on these indexes, you can show you can show the expiration dates. If you go to general and the price axis, you can show, actually, I think, can you? Time axis, there it is. Show expiration Fridays. Now, here's the thing. If you do show expiration Fridays, and we put that on there, that's only going to show those Friday expirations. But you remember, we look at this trade tab, and we've got expirations that are every single day. Now, we also have expirations that are AM settled expirations. So here is the difference. And I told you I was going to talk about this. And I'm going to talk a little bit deeper about this in terms of that volatility. This 19 September expiration has two separate two separate expirations. One is AM settled and one is PM settled. So here's the thing. This one, the 19 September, stops trading on the 19th of September and settles to the value on the 19th of September. This one, on the other hand, this 19th September expiration, because it is AM settled, what that means is AM settled options stop trading the business day before their expiration date. That's why this says 15 instead of 16, because this one stops trading on the 18th and settles to the opening price or the opening print on the 19th. That is the difference between an AM settled and a PM settled option. Now, what that means is if there's not that last day to trade that option and the index makes a move between the closing time at September 18th and the opening on September 19th, those options that stopped trading on the 18th, these AM settled options, are going to settle at whatever the index was on the morning of the 19th. So there is overnight risk. You know, one of the questions that people ask is, why would there be those options? Why would they exist? These are here primarily for the purpose of institutions being able to hedge positions and being able to hedge overnight position risk. So one of the things that we'll think about is not getting necessarily tied up in trading those options. Now, Kelly, yes, it is confusing. So one way to do that and to avoid that confusion is just stay away from AM settled options. Now, when we trade something like a VIX option, we go to VIX and we trade the VIX options, then those are all AM settled. So one of the things that you might think about if you're going to trade something, if you're going to trade a strategy on something that has an AM settled option, is don't hold it till expiration. Don't hold it all the way until expiration. You can still trade it, but don't hold it all the way till expiration so that you don't run into that situation of that overnight risk. There's the simple answer to solving that particular problem. So let's go back to RUT, Russell 2000, and I'll show you why. Because on the Russell 2000, we have a long call option. And we bought that long call option. This is the 22.90 strike. We bought that long call option for $82.10. It's currently trading at $93.10. It's been making some money for us. It's going in the direction that we want it to go. Let's look at the chart for, let's go to RUT right here. And let's go to our grid. And we can see that that chart's been moving a little bit higher here. So we're going to turn this into a diagonal spread, much like we would do with a covered call or a poor man's covered call, where we've got a long option as the long trade, right? So we're long the 27 days to go until expiration. I want to do this quickly here. We're long the 22.90. What we're going to do is we're going to sell an option with a shorter expiration date to bring in a little bit of premium, increase our potential gain. So I'm going to do this really quick. We're going to come up to where this resistance is, up at the 2385 level. And I'm going to sell the 2385 expiration, 14 days to go until expiration. So we're going to sell the 23, that's going to be an out of the money option, 2385, and we're going to bring in $24.40 against the cost of that option, which has already gotten more expensive, which is what we wanted to do. So we're buying down the cost of this option. We're going to sell that 2240 that 2385, and we're going to bring in $24.40. Now, we know that right now, if we were to click on confirm and send, this is going to show infinite risk, but we also know that we also have that long option. So that we're going to put this in our index options group, and we're going to click on send, read through the order, send that order off, and that filled for us. We brought in $25.50. We're going to go to the monitor tab, and now that we brought in that $25.50, that increases the overall profitability on this particular trade. We want this option to get as cheap as possible, as quickly as possible, so that we can do it again. This is a long call diagonal spread that we just created. Let me show you where you can find more information, and we'll continue to follow up with this. I'm going to pop back over here to the Trader Talks webcast page, youtube.com/@Trader Talks webcasts. Long diagonal. Now, here's the thing. One of the reasons why some traders don't like to use long diagonals is because you're selling an option. And because you're selling an option, there is that potential for early assignment. But with a long diagonal on a cash secured index, or cash settled index, that's European style, you don't have to worry about that early assignment. So it gives that potential benefit. Now, here's Cameron May talking long verticals and diagonals here in the Long Verticals and Diagonals playlist. This is a great playlist. Click on the subscribe button right here. That's the one that we were talking about earlier. That's going to keep you connected to this Trader Talks webcast page. Oh, and by the way, you can follow us on X, @BenWatsonCS, @CameronMayCS. Guys, thank you so much for being here and joining us. For those of you that are going to be joining us in Washington, D.C., not this coming weekend, but the following weekend, I look forward to seeing all of you there, meeting you there. Come and say hi. My thanks to Cameron May, and my thanks to our great production staff and our great reviewers today in helping out with this particular webcast, as we've covered a lot of ground. Like I said, I'm going to do a quick short video that'll come out here on X. You'll find it in our shorts. Hopefully it'll be today, maybe tomorrow, on the difference between AM settled and PM settled index options, just as a reminder. Thanks to all of you. We'll see you again very soon. Thanks, Cameron. Take care, everybody. Bye-bye.